Hello, all my students. Today we are going to talk on some examples on marginal costing for TY/BCom semester 6. This is the recap of whatever we have seen in the previous lectures. That is, we have already seen the concept of PV ratio. We have seen the concept of break-even point, as well as we have seen the concept of margin of safety. Today we are going to talk on some practical example area on these areas. This is the session agenda, that is, we are going to learn more practical examples under this marginal costing. This is the example number 1. From the following cost data, calculate first BEP in units, second BEP in units if selling price is reduced by 10%, and third selling price per unit if BEP is 8000 units. The provided information is fixed cost rupees 1 lakh, variable cost per unit is rupees 10 and selling price per unit is rupees 20. So let's start the solving of this example with the first calculation, that is BEP in units. So while calculating BEP in units, we can use the formula as fixed cost upon contribution per unit. Now for calculating this BEP units, we have given the fixed cost of rupees 1 lakh, but we don't have the contribution per unit. Hence, we can calculate the contribution per unit is equal to selling price per unit minus variable cost per unit. So in our example, we have selling price per unit, that is rupees 20, minus variable cost is rupees 10. So we can get the contribution per unit, that is rupees 10. Now we can use this in the formula of BEP units, which is fixed cost upon contribution per unit, that is rupees 1 lakh upon rupees 10. So we can get the BEP in units is 10,000 units. So what we have done, we have calculated the contribution first of all in per unit. Thereafter we use this contribution into the formula, and thereafter we get our BEP units. Now let's move forward to the second calculation, that is BEP units if selling price is reduced by 10%. So original selling price per unit minus reduction by 10%, and we will get our new selling price per unit. So in your example, our original selling price is rupees 20 minus 10% of original selling price, that is rupees 2. So 20 into 10%, it is rupees 2, and if we reduce this 2 from rupees 20, we will get our new selling price is rupees 18. So again we will use this new selling price to calculate BEP in units. So again same formula, BEP in units is equal to fixed cost upon contribution per unit. So we again have the fixed cost, which is rupees 1 lakh, and the latest calculated selling price per unit, and with the help of that we can calculate the new contribution. So the contribution per unit is equal to the just calculated new selling price per unit minus variable cost per unit. So again we can use these figures into the formula, and we can get our solution, that is fixed cost rupees 1 lakh upon the new selling price is rupees 18 minus rupees 10, which is our variable cost per unit. In this way we got our new BEP units as 12,500 units. Then let's move forward to the next calculation, that is selling price per unit if BEP is 8000 units. Before that you must have understood the previous one, that is if selling price is reduced by 10%, we have calculated the new contribution by calculating revised selling price per unit, and with the help of that we have used this new selling price into the formula and we calculated the new BEP units. Now in this third example, in this third question, we have given the BEP units as 8,000, but we require to calculate the selling price per unit. So it is exactly revised of the question 2, where selling price is given but they required us to calculate the BEP units. So again we will use the formula, that is BEP units is equal to fixed cost upon contribution per unit. So let X be the selling price per unit. Hence, how we can calculate the contribution per unit? Again by the formula of using selling price per unit minus variable cost per unit. Now again we can use the same formula, BEP units is equal to fixed cost upon selling price per unit minus variable cost per unit, which is known as contribution per unit. So we have given the BEP units of 8,000. We again have the fixed cost of rupees 1 lakh. Now selling price per unit, which we have assumed that X with the selling price per unit. So X minus, which is given as a assumption, and rupees minus 10, which is our variable cost per unit. So by multiplying 8,000 units into X minus rupees 10 is equal to rupees 1 lakh. Now we will solve this formula. 8,000 X into rupees 8,000, we have solved the bracket first, is equal to rupees 1 lakh. So 8,000 X is equal to rupees 1 lakh plus rupees 80,000. So we got the X is equal to rupees 1 lakh 80,000 upon 8,000 units. So our new selling price will be rupees 22.50. In this way we have calculated the new selling price per unit, where the BEP units is already given in the example. The BEP units was given as 8,000. We didn't have the actual selling price with us, so we have assumed the selling price per unit as X, and according to that we have put the formulas and solve the example. Now let us move towards the example second. Chile India Limited, Chennai provides the following cost data relating to the 1 unit of output. So they have given us the productive material, variable overheads, direct labor, yearly fixed establishment overheads and market price. They required us to calculate number of units to be purchased, produced and sold in a year to achieve break even. So let's solve the first one, where calculation of contribution per unit is required to calculate us. For calculating this contribution per unit, we have the market price, that is our selling price, which is 230. Then we will deduct our variable cost from the sales, that is selling price, and we will get our contribution. So under variable cost we have productive materials of rupees 50. Secondly, we have direct labor of rupees 80. Then we have variable works overheads of rupees 60, and the total variable cost comes as rupees 190. So we will deduct this total variable cost from our market price, which is our selling price. So 230 minus 190, and we will get the contribution as rupees 40. While calculating the variable works overheads, they have given that variable works overheads are 75% of prime cost labor, which is our prime cost labor, that is direct labor, that is rupees 80. So we have calculated rupees 80 into 75%, and we have got the variable works overhead 60. So total variable cost minus our selling price, that is our contribution. So example 1, units to be produced and sold in a year to achieve the break even. So we have required to calculate break even units. This means nothing but we have to calculate break even units. So break even units, the formula is same. what is the formula? Break-even units is equal to fixed cost upon contribution per unit. Now again we in the example we have the fixed cost, that is rupees 2,40,000 upon contribution per unit, which is we have just calculated, that is rupees 40. So rupees 2,40,000 upon rupees 40. So our break-even point in units is equal to 6,000 units. So first of all we have calculated our contribution by deducting total variable cost from the selling price, and we got the contribution and we putted this contribution per unit into the formula, and thereafter we got our BEP units. Thereafter the second calculation is number of units to be manufactured and sold in a year to make a profit of rupees 80,000. This is a new concept where we have to calculate the number of units where desired profit is given, which is rupees 80,000. So the formula for calculating this number of units is fixed cost plus desired profit upon contribution per unit. In our example, again we have the fixed cost, that is rupees 2,40,000 plus they have given the desired profit, that is rupees 80,000, and again we have calculated the contribution per unit, which is rupees 40. So by adding this desired profit into fixed cost, we got our total fixed cost plus profit, and divided by this contribution we can calculate our number of units to be manufactured, which is 8,000 units. Thereafter the next, number of units to be produced and sold to break even if the selling price is reduced by rupees 16 each. So what they have said, number of units to be produced and sold to break even if selling price is reduced by 16. Now again we have to calculate the revised selling price. How we can calculate it? Old selling price minus reduction by 16. So our old selling price was rupees 230, reduction by rupees 16, and we can get our new selling price. With the help of that we have to calculate the revised contribution. So we got our new selling price of rupees 214, which is 230 minus 16, less variable cost rupees 190, and we got the contribution as rupees 24. So now again break even point in units, the formula is same, fixed cost upon contribution per unit. So we have the fixed cost, that is rupees 2,40,000, and the new contribution which is calculated just now, which is rupees 24. So the new break even units are 10,000. So in this way we have learned some more examples on this marginal costing. In the coming session we will learn another examples regarding the marginal costing. Thank you.